Don't put all your eggs in one basket. We hear this all the time, but it's not clear enough what it does actually mean. If you have two baskets, is that enough? What about 20? What about 2,000? Today we're going to look at why holding all your eggs in one basket is risky and what it can mean for investors. This is Mark Perspectives, and we're looking at concentration, or having too much of any one thing. I'm Cam Irvin, lifestyle financial planner and advisor, and this is brought to you by Irvin Wennborn. Concentration means that you're focused or having too much reliance on a small number of things. Concentration is the opposite of diversification. There are a couple of potential upsides to having concentration, but many downsides, and most people have far more concentration risk and less diversification than they think that they do, which, funny enough, becomes its own risk. Sometimes investors might buy 5 different stocks or shares and think that's enough, but come to find out, they've just bought companies like Netflix, Google, Apple, Amazon, and Facebook, which are all tech companies based out of the US, so they aren't really diversified at all. The same goes for housing. Some people will own multiple rental properties within one country, but that still means they're relying entirely on a single country's property market, and as we've seen many times before, things can go wrong. To be clear, when you hear people say that they've lost or known someone that's lost all their money in the stock market, what's actually happened was that they didn't diversify enough and just invested in a handful of companies. That's why they lost everything. The problem is, what gets reported to the press is things like people are losing all their money, because it doesn't sell headlines quite as well to be more precise and say people that made concentrated and uninformed investment decisions had a bad outcome that was statistically likely to happen anyway. Diversified and patient investors that don't speculate will have probability on their side. Gambling's a perfect example of concentration risk. You make a bet and it can pay off handsomely, or you can lose everything. That's how it goes. The financial graveyard of history is filled with concentrated investors. Here are 2 more examples. Back in 2008, Lehman Brothers filed for bankruptcy because of their extensive exposure to mortgage-backed securities that were filled with subprime loans. If you've ever seen the movie The Big Short, that's what it's all about. Another example is Silicon Valley Bank, SVB, which has made a lot of headlines as of late. Here's a better way to visualize how concentration works. Imagine a multiverse where there's an infinite number of worlds and possibilities of what could happen. Some are good, some are terrible, some are weird. In one version of this universe, things are really good, and in another, things tend to be awful. So let's make up a company and call it Potential Future Inc., or PFI for short. And let's say that PFI's stock or shares or value has a certain chance of going up or down in any one given year. So in 2023, let's say $1,000 invested could potentially turn into something like $10,000, which sounds great. Or it might also turn into something as small as, say, $30. That's just 1 year, though. Let's move forward to 2024, and we can see that the same rule still applies. In the good version of the universe, maybe that initial $1,000 grew and went from $10,000 up to, say, $200,000, which is happy days. Maybe in the less fortunate version of the universe, that investment saw a recovery up to $75, or unfortunately could have even gone down further to, say, only $15 in value. Moving right along, in 2025, the same thing again, but it's possible that in the great version of the universe of possibilities, that $200,000 investment went down to, say, only $35,000. And in the bad version of the universe, maybe that investment climbs back up to $500 in values, half of what you had when you started. But it's also possible that it goes all the way down to zero through bankruptcy and insolvency. And this goes on. So on and so forth. You can see that the range of outcomes is entirely unknowable and really, really different. This is how investing in any one single thing works. It's really not reliable at all. But history tells us that the odds are about twice as great that you'll go broke on any given single day compared to hitting it big. So just like the Hunger Games, the odds really aren't in your favor. Why would you want to play a game where your odds are twice as likely to lose, especially knowing that losses are psychologically about 2.5 times as painful as the joy you get from gains? This means you'd have to gain $100 in order to balance out a loss of $40. This was uncovered by 2 Israeli psychologists shown here, named Amos Tversky and Daniel Kahneman, and turned their work into this book, if you're interested in learning more. Basically, concentration is asking for stress and anxiety. So that example shows you how a single investment might do, whereas a diversified investment has so many different components it'll really likely never increase 100-fold in a given year. But bear in mind that it also won't likely ever go to zero. That's how diversification works. It's a way to hedge your bets, which is another way of saying lowering your risk. Investors are better protected, and because they're more diversified, it's more likely they'll achieve a return within a smaller range. A smaller range means the outcome, or how much money someone has in the end, is more predictable and reliable. So going back to the drawing board here, we'll compare the range of outcomes for investing in a diversified portfolio versus a concentrated one. Let's say we have an investor who's building up their wealth over time, up until about retirement, and then they start to draw down on their portfolio until they no longer need it anymore. But this just shows one outcome, and we know that there are tons of other possibilities of what could happen. So when you have a diversified portfolio, here are your other possibilities of what could happen as you're accruing money. There's a range, up and down. And then because that range tends to grow over time, as you retire, it gets a little bit larger and larger. Ultimately, that means that there's a total possibility that somebody could end up with $1.5 million at the point that they die, or zero. We'll compare this to holding a concentrated portfolio of just a few things, and right from the get-go, we can see that when we're building our wealth, it's already a much wider range of what could happen. We could be much wealthier or much more poor. And then once we go into retirement, it just keeps going the same way. So we could eventually end up broke or a multi-millionaire. We can see that the diversified range of outcomes has much lower risk, which actually means that the investor is much more secure, whereas the concentrated portfolio has a much bigger area or range of what could take place. That's why it's higher risk and provides a person with lower security ultimately. So for today's takeaways, we've got a few things. The odds are less than 1 in 4, or 25% chance that someone can pick a winning investment. Sometimes, honestly, the odds are even closer to 1%. Concentration can work, but it's more important to understand that can does not mean it will. It's more likely that something does not work out if you're in a concentrated portfolio. Diversification allows for more consistent investment outcomes. So if you want to plan for your future, diversification is going to be necessary. Lastly, the more diversified, the better. The more concentrated, the more risky. A few hundred investments is considered diversified to some, but our opinion here at Irvin Wenborn is based on the evidence that several thousand investments is true diversification. In summary, the best way to think about this whole concept is, while concentration is the fastest way to impossibly high wealth, it's also the fast train to low levels of wealth. Get rich quick and get poor quick are two sides to the same coin. If you enjoyed this video, reach out. You can always find us at our home on the web at irvinwenborn.co.nz, email, LinkedIn, or Instagram. You can also subscribe or share this video with anybody that you think might benefit from the information.